Hi, and welcome to today's session. This is about understanding the macro environment as an equity investor. A lot of us hear about a number of macroeconomic data like GDP. There is interest rates, there is inflation, there is unemployment, etc. But a lot of times we don't know how to use it as part of our uh, investment journey. So, this session is going to give you a brief overview, a simple framework, a simple sort of a structure. I don't want to overcomplicate things. Any person should be able to use this data with the right kind of understanding. So, first of all, what we need to understand is there are four macro cycles. Only we think the economy is always growing, but there are four cycles. So growth followed by deflation, followed by a decline, and then there is inflation, and then that then leads to growth. So understanding where we are in those four um, cycles, and it basically takes several years in each of these cycles. So an economy could be in one stage or rather one cycle, maybe growth cycle, for several years, in fact even a decade or whatever, and then when it goes into another uh, cycle, then you find that it might take much longer than the earlier cycle, or in some cases much shorter than the earlier cycle. So understanding where we are is very very important, and what we also need to understand is uh, various economies around the world could be in different cycles altogether. They need not be, like the whole world is in growth stage, that sort of a situation. It doesn't need to be that. It can be in different stages. But how do we understand this? How do we figure out where we are, from a global perspective, our own economy, the US economy, etc., etc. How do we try and find this out? There's a lot of macro data that is available to us, and a lot of times what we hear is GDP numbers, gross domestic product numbers being discussed by the media very frequently. But we have to understand that the GDP is only the tip of the iceberg. So, in my presentation, I have provided almost like a pyramid sort of a structure. The base of that pyramid is consumer spending. So the economy grows only because of consumer spending. It doesn't grow because of policy. It doesn't grow because of tariff. It doesn't grow because of supply, etc. You can have 1,000 items on the shelf, but somebody's got to spend and buy that. Only then the economy grows. So as simple as that, that is where it starts. Then the next level is trade, right? So that is the supply chain. There's import, export, people, companies buying from one another. There is, orders being made for long-term capital goods, etc. So this trade process is the next step from there. When consumer spending is there, then the next step is trade. Then, in order to handle this, there has to be investment in the economy from the government itself, and for that, basically, if the government has to spend, they are borrowing to spend it. So they first spend, and then they recover it through taxes, national insurance, etc., etc. Right? So, as a fact, that basically the next layer is public finances. The layer after that is interest rates. Now, that is also a very publicized number. The Bank of England's interest rate numbers, the US Fed's interest rate numbers, highly publicized. The moment you see that, there is, like a market frenzy, and then immediately there is, no. Basically, the reality is interest rates are a lagging indicator. So, whatever you see today is an effect of interest rate decisions that were made 1.5 years or even 2 years before. That is what you are seeing today. Then, on top of that, you have unemployment. Now, unemployment again is a lagging indicator. So it doesn't tell you, uh, 4% of people are going to be unemployed next quarter. That's not the number, right? What it tells you is, uh, in the last quarter, there was 4% of the working age population that was unemployed. Again, there's a difference in unemployment numbers between what the world produces versus what the US produces. The US produces a lot of data, not necessarily right or usable data, but we'll come to that at a later point. But uh, the idea is unemployment is essentially a lagging indicator. On top of that, we have inflation. Inflation again is not instantaneous. And again, as an example, what I say is I walk into Tesco, I've got a shelf with carrots, bananas, and whatever. In fact, our Tesco is exactly like that. But as soon as you walk in, that's the shelf that you see. Now, uh, I'm not saying carrots were 80p last month, and now it's 90p. That's not inflation. It takes into account a basket of things, right? What routinely people buy, and then if everything has gone up, meaning that overall spend has gone up, then it's called inflation. Every single price increase does not become inflation. Then on top of that is GDP. So you get the idea now. You're basically building up this entire pyramid, and on top of that is GDP. That's how this essentially functions. So when you kind of get a view of the tip of the iceberg, then you understand that this is basically a coincidental piece of information. There is a entire iceberg at the bottom of that uh, small piece of information that you got as GDP. Now, the way I tend to explain this in a very simplistic way is like, let's say I've got a phone and I've got various apps on my phone, and I want to see how each app will be impacted by, let's say, a software update, right? So, uh, for the world to function, it needs a OS, right? The phone OS, like your Android or iOS, is basically US dollar. Uh, if you are in the US, then you can pretty much use the OS. You don't need any launcher or UI on top of it. But if you are uh, like me in the UK, so I'm going to be using the pound as my launcher or UI, in order for me to execute transactions, etc., etc. Three big UIs are there in the world. It's the pound, euro, and the Japanese yen. And you kind of uh, you kind of pick the UI based on what you want to do. Now, your phone battery needs charge. You see, let's say my phone right now is charging and it says 76% on it, right? So that's oil. The global oil market pretty much acts like a battery charge for the economy. So oil prices, when it goes up and down, it's like the battery percentage going up and down, really, right? Uh, for all we think, green economy, etc., etc. Yeah, that is fantastic, but oil still plays that role until it is kind of replaced completely by renewables, etc. At some point in time. Uh, then you've got a number of notifications on the home screen, right? That's basically the derivatives market. right? Some of it is clearly noise. Some of it is clearly signals, meaning useful information that you can get. But that kind of tells you what's coming up. Like, so it's like telling you some friend basically liked your post. Not much information really, but that's how the derivatives market really works. As an equity investor, I'm not saying this as a futures trader or as options writer, options trader, etc. I'm saying this as an equity investor, right? And you have to look at it as an equity investor. How is the derivatives market giving me information which I can use in a sort of meaningful way? Now, I use various apps on my phone, uh, but most of the work gets done through email and text, right? Or WhatsApp as well. WhatsApp can be considered text as well, right? So these two, that's the stock market. So that's where equity investor is actually doing their work. So how that market goes up and down based on the OS, based on the macroeconomic data that you got, etc. That's something that we're going to study. Now you've got you know uh, sometimes when you go into a theme park, like I remember we actually visited a theme park like a few years back. Uh, every ride has got a massive queue in front of us. So you're talking, for a 2 minute ride, you're going to be waiting 40 minutes. But as you enter the theme park, they tell you you can download this app, uh, pay £100 extra or whatever. And then what it does is it basically gives you a VIP access, right? Now, I want to go on this particular ride. I click on this, and then it gets you right in front of the line. It gives you a QR code there. You go and scan it, and then it gets you straight in front. That's the money market for me, right? Uh, it's kind of a VIP app. Not most of us can't play in that market because we are not that big, but we can kind of understand what is going on there. So if we see many of the VIPs going in, so our line is going to be even more delayed. So we can kind of understand that information. Or if you see that many VIP families are going in, then okay, so there's a lot of interest for this particular ride. So that's how to look at that. You've got the bond market. Again, I would say I would kind of equate it to LinkedIn. We know that what gets done there, big boys play there. I've been on LinkedIn for a long time, but I can tell you, uh, you know, most people can't figure it out, right? So that's reality there. And again, a lot of money is needed for you to invest into bonds, etc. Or otherwise, you basically get into the bond market using an ETF. Now you have another market called the commodities market, right? I equate that to something like Instagram or TikTok, because more likely to be jealous of somebody by actually opening that app. There's more heartache by looking at it than anything else. So I tend to reserve it for moments when I have a lot of time in hand. But understanding the commodities market then gives us a little bit more information to trade the stocks. So that way it is also useful for us. Uh, Now you're driving on the motorway, the car breaks down. Now what you do is you can call 999, but then if it's not a life and death situation, if it's basically a car breaking down, then what you typically do is open up your phone. You have AA or RAC app on your phone. You click on that. It takes your location, it notifies them, and then it sends you a, basically a breakdown van for them to come and take a look at your car, etc. Right? That is gold. Now, if you see a lot of people calling up RAC because they've broken down on the motorway or in some rural path or whatever they've basically broken down, then it means that there are a lot of cars that are breaking down. A lot of people are having trouble. So that's how the gold market goes. So that's how to look at gold in itself. Uh, with that information, that kind of a background, you might understand that it's not that complex to figure out the macro environment. But then you need a simple way to figure this out. So my framework is very, very simple, just four steps in it. First of all, I group the indicators by type. Some of them are leading indicators, some of them are lagging indicators, some of them are purely coincidence. Right? Group them, and then I analyze these indicators in a sequence. What is it telling me? Right? Is it giving me an indication that the economy is growing or not? Is there a squeeze? Is there something that's coming up? Now, then the third step is I look for any deviations. If one indicator is giving me some information and then the lagging indicator is telling me something else, then I know there is a trend that is likely to break up at this particular point in time. Now, and then most importantly, the fourth step is to look for long term trends. In macro uh, trades, macroeconomics, things take a long time for anything to happen. So this is not a case like S&P had a drawdown and then immediately the panic selling. That's not that. Macro, it takes 6 to 8 quarters for anything to come up, right? So what you are seeing now actually is that process that can was kicked down the road 6 to 8 quarters before, up to 2 years before. So that's how long it takes for things to kind of work. So we tend to look at it as long-term trends, how it is playing up right now, and what is happening in the interim. A very important and simplistic model that I use for analysis and then applying it to a specific stock is a model that I call EIC, right? This EIC model is used by banks and other credit institutions. It's very simple: economy, industry, company. So first step, economy. Is it growing? Is it stagnating? Where are we right now? Now, second step, if I'm looking at retail industry now, retail, how are the retail numbers right now? What is happening over the last few years? Is it stagnating? Are people buying more, etc., etc.? That gives me an indication about the industry. Then go to that particular stock, right? So that particular company, is the company better than its peers or is it worse than its peers? So this sort of a model is simplistic, easy to use. Uh, Anybody can try it. So, as I said, all of this data is available to you. You just need to make sense of it, create a trend, and then you can then apply the EIC model very easily, and you should be able to kind of analyze it. Next step, when we try and construct this house of ours, what we have to understand is we have to lay a foundation first of all, right? So without that foundation, building this house like a pack of cards doesn't help, right? So that foundation is a set of sectors that grow well, uh, even under stress. So the way I say this is people still eat, People will still pay rent, mortgage, etc. People will still pay utility bills. They will they will still get sick, right? They will still commute to work, uh, maybe not take holidays and all that, right? So they still commute to work. uh, their cars will still need servicing. Maybe they will not buy a new car, but cars will still need servicing. um, they'll still send the kids to school, right? So anything educational, etc., still works, right? Unless it is like private schooling and whatever, it basically goes down when there is a crisis. Uh, and then what you then find is, when there is that kind of a crisis sort of a situation, people tend to switch to cheaper products, right? So if I was typically looking at retail, uh, in the event of a crisis, a Waitrose or M&S shopper maybe switches to Tesco, or switches to Sainsbury's, switches to Aldi or Lidl, right? Downgrade, 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 downgrade to that. Okay. So again, they're buying the same food, but the cheaper products. They're buying the same cleaning products, the cheaper products. They're buying the same household items, but the cheaper products. So that base, I can say, uh, of discount retail, consumer staples, education, healthcare, housing, utilities, etc. This foundation, on top of that, you can start building up your house, right? So if this foundation is strong in your portfolio, then you can start adding stocks which are with discretionary purchases, right? Maybe luxury goods, etc. You can start adding on top of that, right? So with that sort of a framework, we then look at how to use these indicators meaningfully, right? I think what we said was, um, the base of that pyramid was consumer spending. So is it going up or down? Now, if you look at our most recent numbers, you'll see a small uptick in consumer spending. Then immediately a lot of media outlets are telling you, there's no problem in the economy, everything is hunky dory, fantastic. But you have to go look at last 2 to 3 years data and then compare it. Only then you will know. Let's not look at the pandemic data, but at least from 2022 onwards until now, only then you will know whether the actual uptick that the media is talking about is really there or not. I leave it to your own analysis here. I'm not going to give you a judgment, but I leave it to your own analysis. So, whichever economy you are uh, analyzing, go ahead, have a look at that. Right. The next step that you kind of look at is GDP, production numbers, etc. Is coincidence, right? Is it showing a growth year on year, quarter on quarter? You have to look at both, right? Quarter on quarter, year on year, and again go back a few years and see how we have progressed so far. And if you draw a graph and then see where we are, that kind of gives us an indication of how we are progressing so far. Is it a growth cycle? Is it a declining cycle? Where are we right now? Then you have a set of lagging indicators like unemployment, interest rates, etc. These confirm the trend. They don't tell you a lot of information. So for all you like, and I don't want to disappoint a lot of people, a lot of people are very very passionate about interest rate decisions, and they jump onto news channels immediately when there's a Bank of England or ECB or Fed interest rate decisions. I don't want to disappoint you a lot. It doesn't mean a lot at all, right? But it's basically a lagging indicator. It kind of confirms a trend where we are going, right? Next, Uh, one of the questions that we've seen come up in a lot of things um, is there just one channel for money flows? Um, are there more number of channels? Are there global trends? Um, and why is a US policy like tariff causing trouble here in UK, here in India, etc., etc.? Now, I need you to understand there are three channels here. Three channels. Number one channel is a policy channel. Whenever there is a difference in rates between one economy and the other, like like right now, the US Fed versus UK, Europe, and the rest of the world, you will have a policy related channel. So fund flows will go based on interest rates. The second channel is a trade channel, right? Like it or not, uh, in the last, I would say, 30, 40 years of globalization right now that we've had, every country is buying from every other country, buying and selling to from every other country. So take the UK, for instance. So for all you like, US, China, US, China, China, US, there's the war and whatever, basically sort of a trade war. For all you like it, every country in the world is trading with every other country as well. So this the trade channel. If you look at the UK, we have over 80 trading partners. So we are buying stuff, we are selling to about 80 countries around the world. So that's reality. So that's the sort of trading channel that we need to understand. The third, very importantly, again, it might be disappointing for some of you, basically the risk channel. So media likes to tell you that there is risk on, risk off, etc. What does that mean? It means nothing. It's absolute BS, really. So how we look at the risk channel is the world's safest asset, US Treasuries, then you've got bonds, you've got US stocks, then everything international. So our gilts falls behind US stocks. So though we say gilts are 100% risk free in UK, remember that there is basically a US is using its OS directly, whereas we are using basically a launcher or UI called Pound. So that basically translates a risk. Secondly, most importantly, from a risk perspective, it's not just about um, risk of default, right? We also have to look at how soon and how quickly can I get out uh, of a particular market. That's one of the reasons why gilts, our stocks, our bonds are below that particular benchmark, right? Even though we might be, from a risk perspective, we might be lesser risky from that, but the way the channel works is like this. Um, I know a lot of us as equity investors like to use fundamental analysis. Now, how to integrate macro and fundamental analysis? The way I do it is I look at macro as setting the tone and context. Uh, it kind of tells me which direction we are going, right? Um, and then the sector, whether the sector in itself is serving a need or a want, and if it is a want, is that want discretionary or is it luxury, etc., etc. Then you have the fundamentals of that particular stock that I'm looking at. Uh, I look at three factors for the stock. One is pricing power. Um, Secondly, I look at the moat or competitive advantage. Thirdly, I look at the debt. Some business models are debt prone. For instance, industrials, right? They tend to take on a lot of debt in order for us to in order for them to execute their orders. But when rates increase, basically the debt burden automatically increases as well. So that's something to be aware of. For the moat, I tend to look at free cash flow and return on invested capital. Pretty simple. You can get it out of TradingView or Google Finance, any of the the common tools that are available. I use that to kind of understand what is the moat. Lastly, when you've taken fundamentals, you should look at the valuations as well. And for valuations, I tend to look at price to earnings, price to sales, and price to free cash flow. And I tend to go back a few years, at least 5 years, if possible, 10 years, and then compare it. I also compare it with the peers as well, peers in that particular sector as well. So with that, that gives a pretty good image in terms of where we are going with this particular stock, right? If you will see our analysis of earnings, etc., we use the seven-step quantamental framework, uh, but even within that, we are using pretty much the same structure. It's a simplistic sort of a mode, but it's quite meaningful in terms of how this works. Lastly, I'm going to give you pretty much like an example. So, where are we in the market cycle currently? Uh, Global economy, and also very specifically, also the US, UK, and almost all of the Western economies, it's slowing or declining, right? That's the reality. We are not in a growth stage. So, as much as media outlets and your research firms and your broker would like you to believe that we are in a growth stage, we are not in a growth stage, unfortunately. Um, Global trade, geopolitics, because of Trump's tariffs and the resultant uncertainties, um, I'm generally avoiding companies with very complex global supply chains. I tend to go for more simple supply chains and, if possible, local supply chains. So the impact of tariff, if it goes seesaw, I'm still okay with it. Rates, I think I mentioned this already. We have a divergence between US Fed and the rest of the world. And that triggers flows in both the policy channel as well as the risk channel, right? So that's the third part I look at. Sectors, I think I mentioned that right now in a declining sort of a market with a divergent rates, etc., the best bet is the foundation, right? I talked about the foundation. Tend to look at the foundation as such. Uh, Fundamentals, good pricing power, wide moat, low debt. That's the best combination right now. Valuations, I tend to prefer companies with lower valuations. Um, Again, don't look at one of them and then say, that's a fantastic company. No, I take a very integrated decision. So should you, right? If you are protecting your wealth, I think you should look at an integrated decision. Consider all these factors and create your own sort of a framework and understanding. Make an integrated decision. Thank you. Thanks for watching this session. This is a recording from Sunday's session. Obviously, not the live recording, but this is basically a recording from Sunday's session. So, thank you. Thank you. Thanks for watching. See you in our next event. Bye.